Warren Buffett: if you don't find a way to make money while you sleep, you'll work until you die. You've heard it before, don't work for money, make your money work for you. But here's the thing, most people think you need to be a Wall Street genius to pull that off. Spoiler alert, you don't. Dividend investing is actually one of the smartest and simplest ways to start making money while you sleep. Today I'm breaking down exactly how you can turn your hard-earned cash into a passive income stream through dividend investing. And no fancy finance degree or Wall Street experience is required. In this video, I'm going to show you and John how to make your dividend portfolio not just work for you, but work smarter and harder while you're enjoying your well-earned sleep. I'm also going to show you how you can achieve that with stocks and ETFs. And in the end, I'll show you a combination of dividend-paying stocks and ETFs that can turn $10,000 into a $3 million portfolio that pays over $10,000 in monthly dividend income. Alright, so let's start at the beginning. What are dividends, and how do they work while you're off dreaming about that tropical vacation? Dividends are simply a portion of a company's profits that get paid out to shareholders. Think of it like this. When you own a share of a company, you're basically owning a tiny slice of that business. And each year, mostly quarterly, they reward their shareholders, which is you, by giving you a little cash payout. This is your dividend, and the beauty of it is you get it no matter what the stock price is doing. In short, you're getting paid just for holding on to something that you already own. It doesn't matter whether you're at work, out with friends, or yes, sleeping, the company will keep chugging along, making money, and sending you your cut. That's how you make money in your sleep. But here's a pro tip. You don't just have to invest in individual dividend stocks. You can simply start with an ETF, which stands for Exchange Traded Fund. These are baskets of stocks, meaning you're investing in dozens or sometimes even hundreds of companies all at once. ETFs can be laser-focused on dividend-paying companies, which means not only do you get the benefit of diversification, but you also get dividends from multiple sources. And even better, many ETFs automatically reinvest those dividends for you, which leads to what we call the snowball effect, which I'll explain later on. Now, before you go out buying random stocks or ETFs, let's talk strategy. Not all dividend stocks are created equal, and the same goes for ETFs. When choosing dividend stocks, you want to look for companies with a history of stable or growing dividends. These are companies that, year after year, share their profits with shareholders, and often they increase the amount they pay out. So where's a good place to start? I like to look for companies in sectors like consumer goods, healthcare, or utilities. These industries tend to be more stable because people always need toothpaste, medical care, and electricity, right? Take a company like Procter & Gamble. You probably have one of their products in your bathroom right now. They've been paying dividends for over 130 years, and they've increased their payout for 68 years in a row. That's what we call a dividend king, a company with a track record of raising dividends for at least 50 consecutive years. Owning shares in companies like these can help create a reliable source of passive income. But if you're like John, you might not have time to research individual stocks. This is where dividend ETFs shine. Take something like the Vanguard Dividend Appreciation ETF with the ticker symbol VIG. It invests in a bunch of companies with a history of increasing dividends. You get the benefit of owning many dividend-paying stocks, which spreads out your risk without having to individually pick them yourself. So how do you decide between individual stocks or ETFs? Well, it all depends on how hands-on you want to be. If you like the idea of researching companies and building your own portfolio, dividend stocks can give you more control. But if you're looking for simplicity and don't want to constantly monitor individual stocks, ETFs are a great way to go. Plus, many ETFs come with a lower price tag since you're essentially paying one price to own a basket of stocks. Now let's talk about what makes dividend investing really powerful: reinvesting your dividends. This is where the snowball effect comes into play and where the magic of making money while you sleep becomes a reality. It simply works by taking your dividend payments as cash and using that cash to buy more shares. These additional shares generate even more dividends, which you then reinvest to buy more shares, and so on. The cycle just continues. It's like a snowball rolling down a hill, getting bigger and bigger as it picks up more snow, even while you're sound asleep. Let's break it down with a real-life example. Say John invests $10,000 in Watsco, a company known for its impressive dividend growth and consistent performance. It has a current dividend yield of 2.85%, a strong dividend growth rate of 19.06%, and an average share price appreciation of 18.99%. Based on these metrics, after 1 year, John's investment could grow to approximately $12,184. By year 5, his portfolio could be worth around $26,855. Fast forward 10 years and the investment will reach approximately $72,147. If John holds on to his Watsco shares for 20 years, the value could rise to an impressive $521,380. By the 30-year mark, John could see his investment rise to $3,774,069, with annual dividend income soaring to around $90,047 or about $7,504 per month. Over these 30 years, the total value added to John's portfolio would be approximately $3,764,069. You can see in the latter years, the growth is exponential, so the longer you let your Watsco dividends reinvest, the more dramatic the growth. Over time, even small amounts can grow into a significant sum. This is why starting early and being consistent is so important. With Watsco's strong history of dividend growth and capital appreciation, this strategy manifests the classic principle of slow and steady wins the race, but with the added advantage of making money even while you're not actively working for it. That is the power of compounding and the ultimate goal of making money in your sleep. Now, if you think $90,000 in annual dividend sounds impressive, stick around until the end to see how my portfolio pays over $130,000 with the same valuation and how you can achieve the same. Okay, let's say you're a bit more adventurous. Let's throw covered calls into the mix. It sounds complex, but trust me, it's not. Covered call strategies involve selling call options on stocks you already own. In simple terms, you're getting paid a little extra cash for agreeing to sell your stock if that stock hits a certain price. If the stock doesn't hit that price, you just keep your shares and pocket the premium. Why does this matter? Because covered calls can provide an extra boost to your dividend income. Some ETFs, like the Global X NASDAQ 100 Covered Call ETF with the ticker QYLD, use this strategy to generate higher yields for its investors. With QYLD, you can earn dividends as high as 11.49%, and they pay on a monthly basis and have been consecutively paying out over the past 9 years. In dollar terms, it's $1,150 paid every year to John if he invests $10,000 with them. But the downside is that covered call ETFs tend to underperform in strong bull markets because you're giving up some of the upside potential for that extra income. But if you're looking for more immediate cash flow and don't mind slower growth, this can be a great strategy to explore. Now let's circle back to one of the most important rules of investing: diversification. If you want to make money in your sleep and keep stress levels low, you need to spread out your investments. That means not only relying on a single company, a single industry, or even a single country. You never know what could happen. A company could cut its dividend, an entire industry could face headwinds, or even geopolitical issues could shake everything up. The easiest way to diversify is dividend-focused ETFs. They spread your investment across many companies and industries, giving you exposure to multiple sources of income. This lowers your risk because if one company cuts its dividend, the impact on your overall portfolio will be minimal. You could also diversify by investing in different sectors, such as tech, healthcare, and real estate, or even by adding international dividend-paying stocks to your portfolio. One of the prime examples is ProShares Ultra Pro Dow 30 with the ticker symbol UDOW, and it offers an intriguing combination of dividend income and capital appreciation through its leveraged exposure to the Dow Jones Industrial Average. UDOW provides triple the daily returns of the Dow 30, making it a higher risk, higher reward option, but its long-term potential can be significant for investors looking to add a growth element to their dividend portfolio. Let's say John invests $10,000 in ProShares Ultra Pro Dow 30. After 1 year, John's investment could grow to approximately $12,092 thanks to capital appreciation and dividend reinvestments. After 10 years, the investment could grow to around $69,042 with dividend income totaling $4,052, a solid return for a relatively hands-off investment. By year 20, John's investment could potentially rise to $536,380, generating an impressive total income of $66,666 in dividends. And by year 30, the portfolio value could rise to around $5,306,969, with dividends soaring to a staggering $27,206 per month. Another way to diversify is by mixing different types of income-producing assets. For example, along with stocks and ETFs, add REITs, or real estate investment trusts, to your portfolio. These are companies that own and manage real estate properties, and they're legally required to pay out 90% of their income as dividends. So by investing in REITs, you can get exposure to the real estate market without the hassle of becoming a landlord. Let's take Rexford Industrial Realty with the ticker symbol REXR, for example, and see what could become of John's $10,000. After 1 year, John's investment could grow to approximately $11,750 thanks to capital appreciation at a 3.68% dividend yield. After 10 years, John's investment will be around $49,932. Fast forward 20 years and the portfolio might expand to approximately $246,826. After 30 years, John's initial $10,000 investment could rise to $1,208,316, with dividends over this period providing a total income of about $34,483, or approximately $2,874 per month. Now let's bring everything together by creating a portfolio that blends the best of each investment we've discussed: Watsco, ProShares Ultra Pro Dow 30, and Rexford Industrial Realty. By diversifying across different industries, asset classes, and strategies, we're building a portfolio that maximizes both dividend income and capital appreciation. This means you'll not only earn consistent payouts, but your portfolio will also grow over time, creating wealth while you sleep. Here's what makes this portfolio so powerful. It combines steady dividend growers like Watsco, aggressive capital appreciation through ProShares Ultra Pro Dow 30, and reliable real estate-based income from Rexford Industrial Realty. With each asset contributing a unique strength, this portfolio is designed to not just provide passive income, but also long-term growth through reinvestment and compounding. And here's what it'll look like. The combined current dividend yield is 2.49%. The combined dividend growth rate is 20.06%. And the combined 10-year average share price appreciation is 17.65%. So let's take John's $10,000 and invest in this portfolio with those numbers. After 1 year, his portfolio could grow to approximately $12,014. After 10 years, the portfolio has the potential to reach a valuation of $64,162. That's when the snowball effect kicks in. Fast forward 20 years and John's portfolio would rise to about $437,927. And in 30 years, the portfolio has the potential to reach a massive $3,231,206, paying around $130,900 in annual dividends, or roughly $10,908 in monthly dividend income. The total value added to John's portfolio will be $3,221,206, with $2,568,183 coming from capital appreciation and $653,024 coming from dividend reinvestment. Want to know how the snowball effect really works? Turning a $10,000 investment into a $9 million portfolio? Click the video on the screen.